Student loans just changed completely, and almost nobody's talking about it. This channel breaks down exactly how your money actually works. Subscribe and tap the bell so you don't miss it. Over 42 million Americans carry federal student debt. This year, the system was rebuilt almost overnight. New repayment plans, strict borrowing caps, and one fine print change that could hit borrowers with unexpected tax bills worth thousands. If you have a student loan or you're about to take one out, the rules you think you know don't apply anymore. Here's what nobody prepared you for. For 2 years, borrowers were told to wait. For courts, for new plans, for letters that never explained anything. You paid on time, checked your account, and still didn't know which plan you were on. That confusion wasn't yours, it was the system. Now the waiting is over and payments are here. If you were on the SAVE plan, it's gone. If you were counting on forgiveness, the tax rules flipped. If you were about to borrow for grad school, the amount you're allowed to take just shrank. None of it made headlines. So let's break down what changed, what it costs, and what to do before deadlines close. Let's start with the biggest shift of all. Part 1, the big reset. In July of 2025, a sweeping federal law rewrote how student loans work in this country, and there's a lot riding on it. Nationally, Americans now owe close to $1.8 trillion in student debt, the second biggest pile of consumer debt after mortgages. Starting July 1st, 2026, the new rules officially kicked in. The old repayment plans, SAVE, PAYE, ICR, are gone. SAVE, the plan that let some borrowers pay $0, was struck down in court. Borrowers sat in forbearance while interest quietly started growing again in August 2025, even though no payments were due. Now loan servicers are contacting the remaining SAVE borrowers directly. Once that notice lands, you get 90 days to pick a new plan. Miss the window and the government picks one for you. That is not a position you want to negotiate from. Part 2, the 2 plans you're actually left with. So what replaced everything? Basically, 2 options. Option 1, the tiered standard plan. A fixed payment based on your balance, spread over 10 to 25 years. Simple, predictable. But here's the catch. If you're working toward public service loan forgiveness, payments on this plan earn 0 credit. And it's the plan you get dropped into automatically if you don't actively choose something else. Option 2 is brand new, the Repayment Assistance Plan, or RAP. Instead of a fixed bill, your payment is based on income, somewhere between 1% and 10% of what you earn, dropping by $50 a month for every dependent you claim. Nobody pays less than $10 a month. Here's what that looks like in real numbers. A borrower earning $45,000 with $35,000 debt used to pay about $176 per month. Under RAP, that drops to $150, with $40 interest waived and $50 extra toward principal each month. As long as payments stay on time, the balance only moves one way, down. Forgiveness under Repayment Assistance Plan takes 30 years, but PSLF borrowers still qualify in 10. If this is helping, hit like, it helps someone else find this too. Part 3, the borrowing limits nobody saw coming. No more unlimited borrowing. Instead, $20,500 a year, $100,000 total for most grad programs. In professional fields like law or medicine, $50,000 a year, $200,000 total. And here's the twist. MBAs don't count as professional, they're stuck under the lower cap. Here's a twist that catches people off guard. An MBA does not count as professional under these rules, despite literally having the word master in the name. MBA students are stuck under the lower general graduate cap. Undergrads, your annual limits mostly stayed the same, though part-time students now see their amount shrink to match their enrollment. Parents aren't spared either. Parent Plus loans used to cover almost the entire remaining cost of a child's education. Now there's a hard ceiling, $20,000 a year, $65,000 total per student. And across every type of federal loan combined, there's now a lifetime cap of $257,500. For decades, borrowing was nearly unlimited. Now, for the first time, there's a ceiling, and it may not stretch far enough for long programs at private schools. One exception, Students already enrolled before July 1st, 2026 may keep the old limits under the legacy provision. Part 4. The move that instantly cuts your rate. Quick one before we keep going, because this next point is the easiest win in the entire video. Interest rates on new loans for the 2026 and 2027 school year climbed again. 6.52% for undergrad loans, 8.07% for grad loans, 9.07% for Parent Plus. Rates you can't negotiate. But here's what you can control. The discount for enrolling in AutoPay just quadrupled, from 0.25% up to a full percentage point off your rate. Already enrolled? It applies automatically, no action needed. Not enrolled yet? You have until the end of September 2026 to sign up and lock it in through June of 2028. On a $40,000 balance, that extra bump is worth roughly $600 back in your pocket over the 2-year window for something that takes about 90 seconds to set up. Part 5. Unexpected tax bill nobody's talking about. Remember that surprise tax bill from the start of this video? Here it is. For the last few years, if your student loans got forgiven through an income-driven plan, that forgiven amount was completely tax-free. That protection expired at the end of 2025, and it was not renewed. So starting this year, if your balance gets wiped out under a plan like RAP or an older income-driven plan, the IRS treats that entire forgiven amount as income all at once in a single year. That can push you into a much higher tax bracket and leave you owing thousands of dollars you never budgeted for. The exceptions that still stay tax-free: public service loan forgiveness, teacher loan forgiveness, and discharges due to death or permanent disability. Everything else, talk to a tax professional before your forgiveness lands, not after. If you're rebuilding after a money shock, your credit habits matter. Ava is a credit-building app that may help you build credit history over time with payment activity reported to major credit bureaus. Check the Ava link in the description. Part 6. The collections clock that's still ticking. Last one. And it's the one with the biggest consequences if you're behind on payments. After the pandemic-era pause ended, the government resumed collecting on defaulted loans, garnishing wages, seizing tax refunds, even withholding Social Security checks. At one point, nearly a quarter of all borrowers were on pace to land in default. Then, in January of 2026, those involuntary collections got paused again while the new plans rolled out. And as of right now, that pause is technically still active, with no restart date announced. This isn't the first time collections have paused. It happened for 3.5 years during the pandemic, and a lot of borrowers got used to nothing happening. This time is different. The pause is administrative, not legal, which means it can end far faster than it did last time. One more twist worth knowing. A rule that could have stripped PSLF from entire employers was struck down. For now, PSLF is safe, but your repayment plan choice is still the bigger risk. Let's bring it all together, everything that changed, in under a minute. Save, Pay, and ICR are gone. Only 2 repayment plans remain. The wrong plan by default can quietly cost you your PSLF credit. Grad Plus is gone, and strict new borrowing caps now apply. AutoPay now cuts your rate a full point through mid-2028. Forgiven balances are taxable again, and collections are only paused. I'm curious to hear from you. Are you switching repayment plans before your deadline? And did these new loan caps change your college plans? Drop your thoughts in the comments. I read every single one. Remember, this video is educational only, not financial advice. Subscribe for more personal finance content. Thanks for watching.